Hello, I'm Lori Lane-Zucker, founder and CEO of Impact Entrepreneur, and welcome to our webinar, Impact Private Equity Funds and Insider's View, with Amy Francetic and Michael Whelchel. And a special welcome to all the members of the Impact Entrepreneur Network attending the webinar. Impact Entrepreneur is a large global network of systems-minded change makers, entrepreneurs, investors, scholars, and students of social and environmental innovation who believe that this work needs to be done within a transformational framework. We build companies, we invest in them, we study and teach about them. But we also understand that we have to collaborate to build a new business paradigm and ecosystem that functions with a very different brain chemistry around those businesses, what we might call an impact economy, in order to find an authentically sustainable way forward. So if you agree with this perspective and are not yet a member, please join the network. It is free. The only entry fee is your commitment to the business of change. This webinar is part of a series, actually two series, that we offer to network members and others. The first series, of which this particular webinar is a part, is called Luminarias, and its theme is Fireside Chats. The second series of webinars is called Building an Impact Economy, and that series is usually topical panel discussions. So our seasons run from September to July. Select programs from our past years can be found on our YouTube channel, Impact Entrepreneur TV. And be aware that you can become a premium member of Impact Entrepreneur and get complimentary admission to all our upcoming live webinars, as well as access to our entire archive of over 50 past webinars. And you can find information on premium membership, subscribing to Impact Entrepreneur TV, and our upcoming webinars on our website at www.impactalchemist.com. That's impactalchemist.com. Okay, well, I'm very pleased to introduce our program and our guest to you now. Back in 2007, I founded a precursor to Impact Entrepreneur. It was called Hot Frog. It started in my nonprofit think tank and incubator, and then became a founding B Corporation, which was one of the first 25 or so of this new type of certified triple bottom line business. As of this week, there are now 3,585 B Corps in 74 countries across 150 industries, according to B Lab. Like many entrepreneurs, I designed a business model that necessitated outside capital to succeed. As a mission-driven entrepreneur, I wanted mission-aligned capital. And initially, I assumed the only way to do this was to make it a nonprofit project that received philanthropic funding. I received grant money from a Silicon Valley foundation to seed the project. But then I was introduced to the brand new B Corp certification, and also to this other oddity that was emerging from think tanks at the same time, impact investing. Now, after researching these two things, you could say that I drank the Kool-Aid. With the help of an investment banker, Michael Whelchel, who is one of our two guests today, I transitioned Hot Frog into a B Corp LLC, limited liability company, and then went out in search of investment. The good news is that we attracted a significant lead investment from a prominent philanthropist and investor who was savvy to the nascent B Corp thing. The bad news was that the lead investment came in the day Lehman Brothers collapsed and the Great Recession began. The other bad news was that we sought additional impact investment capital well before anyone, except a very small body of Looney Tunes like us, knew what impact investing was. Now, there certainly weren't many, if any, impact investing funds to speak of in 2007 and 2008. And as I traveled through the San Francisco and New York private equity worlds and discussed our company's commitment to impact and the triple bottom line, the number of glazed, uncomprehending stares I encountered could easily fill a Make America Great Again rally arena. I did close a modest investment on the first impact investing platform, Mission Markets, which made headlines for being the first of its kind. But searching for impact investing capital in those early years of impact investing was more often than not an exercise in futility, like searching for water in the great outback of Australia. And speaking of Australia, I remember meeting an Aussie entrepreneur at one of our first SOCAP conferences. He had determined a couple of years before that he would not get a new pair of shoes until he closed his funding round. Now, looking down from his pressed business suit, I saw that both his shoes had gaping holes, his socked, wiggling toes standing out proudly. And rather fittingly, the gentleman's solar company was called Barefoot Power. So that's a little taste of what the search for impact capital was like a decade or more ago, and how things have changed. As referenced in the program description for this webinar, there are now at least 1,000 impact investing funds. Additionally, the Business Roundtable of Large Company CEOs recently declared a new era of stakeholder primacy, ESG investing in public equities, not impact investing, but a close relation, has hit the stratosphere. Impact measurement and management has become a serious profession. This is not to say that finding and securing impact capital is easy today. It isn't. It isn't quick. It isn't easy. And especially if you are a female or a person of color, it's practically non-existent. That is what the data says. And if you watch some of our recent webinars, you will have had more than your fill of this data. In today's program, we're going to look specifically at private equity funds in the impact investing space, how they have evolved, where do they show the most promise, and where they are still playing catch up, and whether and how they are remaining true to the original vision of impact investing to have measurable social and environmental impact alongside a financial return. Our two guests are both insiders with different roles. Michael Whelchel, through his Big Path Capital, has worked with more sustainable companies and impact funds than any other firm in the entire space. And Amy Francetic has founded and managed multiple private equity funds, principally in the clean tech sector. Let me introduce our two esteemed guests to you now. Amy Francetic is founder and managing general partner of Buoyant Ventures, a new venture fund in Chicago that aims to invest in digital climate solutions for energy, transportation, agriculture, and the built environment. Her career spans over 20 years of high technology, entrepreneurship, private equity, and research. Amy previously founded and led Energize Ventures, a $165 million venture fund that invests in digital technologies that optimize energy, equipment, and infrastructure. She also co-founded and served as CEO of technology accelerator Clean Energy Trust, which has invested in dozens of early-stage clean energy companies across the Midwestern United States. Amy also held roles at private equity firm MVC Capital and at Stanford Research Institute, where she worked on an early version of the voice recognition technology that became Siri. Amy is a regular lecturer in energy and entrepreneurship at Northwestern University and the University of Chicago's Law School, and she has a BA from Stanford University. Amy, welcome.
Thank you so much for having me, Lori. That's such a great introduction, and I just wanted to throw out that the founders of B Corp were my dorm mates at Stanford. So,
oh, wow.
It's been really fun to see how they've grown that business.
Small world. Wow. Michael Whelchel is co-founder and managing partner of Big Path Capital, Impact Investing's investment bank, a boutique impact investment bank focused on providing corporate finance, M&A, and placement agent services to impact companies and funds globally. Big Path has worked with over 180 impact and sustainable companies and funds, more than any firm in the sector. In 2007, Michael left his 15-year career in private equity to form Big Path Capital with his partner, Sean Lesser, leveraging the engine of capitalism for an expansive economy built on natural, social, and financial capital. Recognizing that impact investing isn't just a different way of investing, but a superior way of deploying capital, Michael is committed to challenging the status quo and to raising the expectation of capital. In this vein, Big Path has created a number of first-in-class initiatives that many of you will be aware of, including the 5-Fund Forum, the Impact Capitalism Summit, and Impact and Sustainable Trade Missions. Michael received his BA from the University of the South and received a joint MBA and and Masters of Engineering Management from Kellogg School of Management at Northwestern. Michael, welcome.
Thanks, Laura. It's great to be here. Really appreciate you inviting us. And it's, I think, one of the great aspects of working in this space is getting to work with people that obviously have just an incredible mission of changing the world, but just working with really great people. And I'm glad that to count you and Amy in that, in that group. So I'm really glad to be here.
Great. Let's see, Tara, Anu, and maybe one or two others have only sent your introductions to only panelists. So if you could copy and paste Jagada as well, if you could, and Annabella, if you could copy and repaste your introductions in and choose all panelists and attendees, and everyone will see your introductions. Thanks so much for doing that. Okay, well, Amy and Michael, I like to begin our fireside chats by asking our guests just briefly about personal experiences as they relate to the professional work that they're currently engaged in. And I'd like to ask each of you to share just one or two early experiences in childhood, in school, or in your early professional work that inspired you onto the path of impact. And Amy, why don't we start with you?
Sure. Well, I came to being committed to spending the rest of my career focused on addressing climate solutions after I was severely ill with cancer at a rather young age. It was in my late 20s, and I had a rare form of cancer, and my husband and I were trying to start a family, and we couldn't start a family. And I discovered in the course of that I needed to address the cancer first. And so when I was able to be healed of that, I quickly had my daughters, who you can see over my shoulder. They're now in high school. I have a sophomore and a senior in high school. But after my girls were born, I decided that I needed to spend the rest of my time doing whatever I could to have purpose in my work. And I thought really hard about what would be that purpose. And I'd always really found a lot of solace and healing in nature. I've been a runner my whole life and love being outdoors. And so I felt like I needed to turn my attention to climate change so that I could do whatever I could to preserve our natural world for my girls and for, their kids and grandkids. And just decided to, spend that, have that be my mission for the rest of my career.
Thanks, Michael.
Yeah, so I grew up in Central Florida, and not the most traditional way. It's pretty, I couldn't call it a hippie commune, but it was kind of in that direction. So for instance, my mother, who really was very health conscious, she wanted us to, have raw milk, not pasteurized milk, and that was illegal in Florida. So, her solution was you buy a cow. And so I grew up milking a cow for the sole purpose of having raw milk. Same with, organic pasture raised eggs. So we just bought bought chickens. And so grew up in that kind of a mindset of, if there's not an investment bank that's helping positive companies, go start it. So I, grew up in just kind of with a little bit of a skepticism towards, kind of the system. And so I think that had an influence early on. And another, I think, influence for me is when I was going through business school, this was in the early 90s, was in business school in Chicago. And you do an internship, between your first and second year. And so I worked with a bank called Shore Bank. And so, in today's parlance, it would be called one of the first triple bottom line banks in the country. And I'd never been up close and personal where profit and purpose intermingled in the way that it did. And so that summer was really instrumental for me to say, I don't know where, when, how, but I want to find myself, in the ecosystem of where, people are using business to, do what it should do. And that's, to have this kind of multiple bottom line impact.
Thanks. A few more of you have put in your introductions and only chosen all panelists. Sagar, Gabby, Joseph, and one or or two others. Can all of you just go look at who's put in introductions, go check out the ones you've put in and make sure you've chosen panelists and attendees. And if you haven't, copy and paste it back in, choose all panelists and attendees. I pay a lot of attention to this because most of you are doing really interesting work, and I want to make sure that everyone's seeing that work and can connect with you if they would like to. Okay, next I'd like to just briefly have you tell us about how you spend your day. Michael, can you give us a little more information about what you and Sean and your team are doing at Big Path day to day? And then after you, Michael, Amy, I'd love to hear what you're doing right now with Buoyant.
Sure, yeah. Zoom, and more Zoom. Right? Like everybody. Yeah, that's kind of gets kind of like maniacal. So I would say, probably half of my day is spent working with, current clients that we're, so our business is helping, impact companies and funds raise capital or do transactions. So companies hire us or funds hire us to go do that. So half of the day is, helping our current clients. So like right now working with an energy efficiency company, it's, 41 million in revenue, helping them, raise capital, working with one of the leading plant-based ice cream companies, raise equity. We just started working with a really exciting bank. So it's a private bank. That'll be more of a commercial bank. And it's one of the first that has climate solutions as its core focus. And so we're helping them go raise their initial, origination capital. So that's kind of half. I'd say maybe a quarter of the day is, talking to new possible new clients. So we're talking to a group that wants to create a $500 million botanical-based holding company. So this would be a holding company that would contain multiple companies that at their core were wanting to use the power of plants. And so we're talking to them about possibly working with them, helping them raise capital. I'd say another quarter is the field building. Like we do the CEO summits, and, helping get that, organized and some of the events that we do. And I forgot the quarter teacher for my 13, IT and teacher for my 13-year-old for home, at home schooling. So that, like a lot of people, that is it's a major part of how we juggle stuff right now.
Gotcha. Amy?
Yeah, well, we are very proud to be working with Michael and his partners at Big Path Capital. They are helping us get Buoyant off the ground. And so we are fortunate that we can use these amazing digital tools like Zoom to connect with folks while we can't travel. And then I'm looking very actively for investments that meet our thesis. And our thesis is in the digital space. So we're looking for climate solutions that are mostly software companies and low-cost hardware companies and technologies that can help businesses and communities address the climate risk in their businesses or communities and help mitigate that risk, or also find adaptation opportunities. And so we're talking every day to companies in the space. We've got a deal pipeline of over 350 companies that fit our thesis. We're early stage investors. So we invest in Series A as sort of our sweet spot. And so we're constantly on the hunt for businesses that we can invest in. And we talk to, entrepreneurs mostly in North America. That is our focus. So we're looking for solutions in North America and looking for businesses that can scale globally.
Thanks. Denise, I don't know if you've done this. I saw your introduction only went to panelists. Can you copy and paste it if you haven't already done this and choose panelists and attendees so everyone can see it? All right, Michael, I want just briefly to head down a little bit down memory lane with you. We both got involved in the impact space. I should mention that it was Michael who taught me to use this word space. While I felt then and still feel today that is a rather strange, even mystifying word, I continue to use it with aplomb because everybody in the space seems to know what the space is and what the word means, even though, frankly, I don't. Anyway, Michael, we both got involved in this space back when it was just becoming a space, when it was arguably more empty space than substance, when it was more idea than practice. Tell us from your vantage point how impact investing, and especially private equity impact investing, has evolved over the past 13 years and where you see it now. And I know you brought along a slide, which you can at this point feel free to use to illustrate your point.
Yeah. I think this might help be nice to just get some kind of a landscape framework. Yeah, I mean, I think, the space has changed dramatically, over these 14 years. So what I've done here is just like on the vertical axis, you can think of these as impact themes. And they're much more than this, but just to give you some sense of the diversity of impact themes that are typically kind of covered. And then along the horizontal axis are asset classes. So these are, different areas that you can invest in that are thought of kind of as separate asset classes. So everything from venture to growth equity to private equity, real assets, direct debt. Directs just mean, individual invest instead of investing in funds, which is more pooled capital, investing directly into companies. And then, I wanted to capture, other ways that people are using either their assets, whether it could be philanthropy, or their balance sheet, which would be kind of like this first loss loans. And so you can think of this as like a, topographical map. And, one other factor or axes that could be added to this would be, expectation of return. So that could be everything from, market rate return to, philanthropy, as in grants. And so there can be another continuum that you could look at that would make this kind of more of a three-dimensional aspect. But, some wealth advisors will use this, to help families think through, how and where they want to invest. And they'll, another term they'll use is like a heat map to where you would like to focus. So, someone could say, climate solutions is my main focus, and I really want to just focus on that. But then you could say, okay, well, if you're going to invest around climate solutions, you could do that across asset classes, and including public, equities. Or if you wanted to, kind of say, well, really, I want to be more focused in venture or in private equity. So this helps just kind of give you some taxonomy to think about a kind of intentional way to invest. And I would say, how this space has evolved, I would say in general, you've seen, where investment has gone from sustainable investing, which I think you could go all the way back to like talk about negative screens, to a move more towards private equity. And then I think now you've even seen more of a move to across asset classes, where people are thinking in a more sophisticated way around how do I diversify my investments in impact. So I think it started kind of more negative screening to more positive screening, and maybe focus more around publics and then private equity. And now it's moved more to where you can even think about like your cash and cash equivalents as having impact. So it really is, it's become much more sophisticated. I'd say also another one would be moving from more of a generalist theme to very specific, to the point like we're working right now with a fund that's even focused on, film around how to, get more stories where the antagonist is a person of color or a woman. So that's, that there's a fund focused on that. So you're seeing much more, I think, very specific themes that are, called out. And then I'd say the size of the funds. When we first started, $100 million fund was large, and, we've broken the $1 billion, threshold now. So the fund sizes are more meaningful. Number of funds. And the last, I think we'll pick it up a little bit later, but I think you've seen initially, like when Laurie and I were out on the road, talking about investments, a lot of people would just assume you're talking about charitable donations. And so I think now that there's really this more imagination in the public's awareness that you can do both of make a return and have impact, where, back, it was very much the outlier of someone who had that imagination, where it's much more, ubiquitous.
Great, thanks. That was very helpful. Perfect. Amy, well, you're here in part to help us dig into one of the sectors of the geography that Michael just presented. Can you give us a picture of the clean energy and clean tech private equity fund universe and tell us how this one sector, from your vantage point, has evolved in recent years?
Sure, sure. So I've lived through, let's see, I've been in the space, I count as 2005 is the first time I started working on clean energy. And I was at Stanford Research Institute, and my job was to help commercialize the research that was being conducted at the Research Institute with primarily government funding and figuring out how to turn those into commercial businesses. So one of the projects I worked on was a fuel cell technology back then. And in 2007 to sort of 2010 was sort of the first wave of clean tech venture activity in this space. And a lot of capital moved into the sector then, and unfortunately did not deliver good returns. And so then a lot of capital left the sector, and the big funds, like all the big, Silicon Valley funds that were creating clean tech activity, moved away. And then that gap was filled by strategic capital for the most part. And I would say in the last 3 to 4 years, there's been a lot more capital that has returned. In fact, when you think about it broadening a little bit beyond energy to include climate, there's a lovely report, and I think I sent you the link, Lori, to PwC put out a report on climate tech investing. And they've counted that there's been about $60 billion invested since 2013 in this space. And it's the same exact verticals that we're looking at that include energy, mobility, transportation, food and ag, heavy industry in the built environment. And of that $60 billion, there's been 43 companies that have been valued over $1 billion. So money is coming back into the sector. One other thing to point out is that the returns have been a lot better. So a lot of the early funds, 2007 to 2010, lost money. But Cambridge, and I sent you a link also to the Cambridge data, in 2019, they published that for funds vintage 2014 to 2017, the top quartile clean tech venture funds were delivering gross IRRs in the mid-20s, which is definitely a venture return. So we're starting to see that this is coming back, and there's a lot of reasons for that. There's the initial wave of investment was really to help develop and commercialize the fundamental technologies, which were mostly hard science and hard tech. And those are really hard to fund with venture capital. They take a long time to develop. They're usually manufacturing intensive, which is very capital intensive. And so the development timeframe, as well as the amount of capital, is not very suitable to venture, where you have a 10-year fund and you're really trying to invest in and then exit those deals in sort of a 5 to 7 year timeframe. So that was part of the challenge. It was almost like a mismatch of capital to the technologies. But a lot of that work helped to drive the cost down of those fundamental technologies, which helped them to get deployed faster. And so now this new wave of climate tech investing is really building on top of that first wave, and where you have renewable energy being very cost competitive, and in many geographies, the cheapest form of new energy to build. You now have renewable energy making up almost 20% of North America's energy supply. There was more renewable energy deployed around the world than any form of energy. So that's all changed in 10 years. And now we have this new wave of investment that can be focused on solutions to enhance that and accelerate that. And that's where we're focusing on these digital technologies. We're not doing hard science investing. We're not investing, for instance, in battery chemistries or alternative proteins or anything that is more of a manufacturing intensive business or material science. We're really looking at the data solutions that can be layered on top of physical infrastructure, and that can drive both risk assessment as well as solutions that can reduce emissions or help businesses and communities adapt. So it's really more of a software play, and those kinds of companies perform a lot more like the most successful IT venture funds. IT, in that same Cambridge report, IT-focused venture funds, the top quartile for them were mid-30s gross IRR. So you can see that those are really, really good returns. And so that's sort of what I think is possible in this next wave of clean tech investing.
Great. Michael, I wonder if you can add to this discussion of returns, particularly kind of beyond the clean tech sector into these other sectors that were in your geography.
Sure, yeah. And, I would say, at Big Path, we've got a certain kind of like philosophy, we call it smarter money. So, the funds and the companies that we work with, we expect to have like as good at, or, as good of a market rate return as their traditional incumbents. And so whether it be affordable housing, you saw one, Jonathan Rose, or, within the clean tech world, or the, some of these sectors that some of these impact funds are focused on are kind of like the wave of the future. And so in some cases, you might even have kind of alpha, which would be, outperforming the market. So, but that's kind of, obviously there are an incredible number of funds out there that, because they may not be seeking kind of that market rate return, have actually maybe even more impact, right? So not to say that those, that's a great, there's a number of funds out there. That's just kind of from our philosophy. We feel like to really kind of move the needle and to get more capital flowing and kind of create like that imagination, public awareness that you can have both. That's where we've decided to focus, is where you have the return and the impact. There's not necessarily trade-off. There's a great story where Mark Andreessen from Andreessen Horowitz was asked, what do you think about impact investing? And he said it's like a houseboat. It's not a good house and it's not a good boat, right? Which is, it can be the, the kind of the typical, comment about impact investing. But if Nancy Fund, if you know of her, she's one of the founders of DBL Partners, which is a great, another great fund out there. And she said, no, it's like brunch. It's better than breakfast, better than lunch. So that's our philosophy. It doesn't have to be a trade-off. Yes, there are some where you want to. And I think also families are getting more sophisticated in how they think about return. And they might say, something, what we'd like to have is a percentage of our capital where we do expect a market rate return. But then we know that there's some, investments out there that aren't going to return market rate return, but the impact is so important that we're going to have like this diversification on expectation of market of returns too as well. So you're seeing here again, it's a more nuanced approach.
Mm-hmm, mm-hmm. Amy, getting back to the returns of the clean tech sector, historically, that sector, clean energy, has really benefited a lot from kind of tax rebates and incentives and so forth. How much of a factor is that in the returns that you're seeing now across that sector? And has it evolved or changed in the last few years?
Mm-hmm, mm-hmm. So you're speaking mostly to the tax incentives for wind and solar deployment.
Yeah.
Right. I think that absolutely helped those technologies compete initially. But now the costs have come down so aggressively, thanks to some, especially in China, and the manufacturing pressure that they have put on the rest of the world to manufacture affordably these technologies. The technologies are very cost competitive even without subsidies. So Lazard puts out a levelized cost of energy every year. It's considered one of the leading authorities on pricing. And there is variability based upon region. But for the most part, wind is the lowest cost new resource unsubsidized currently to be deployed. And there's slated the other factors that I think it's right now, almost 2/3 of all of the coal plants in North America are slated for closure. So as those coal plants close, and the reason they are closing is that they are not able to compete on price, and it doesn't make economic sense to try to implement carbon capture technology to make them cleaner. And so they are planning for closure, and they're being replaced by renewable energy and natural gas for the most part. So I think that's a major factor, is that the unsubsidized cost of these renewable technologies are forcing the accelerated closure of the more costly coal plants. And it's also, in some cases, forcing the decommissioning of nuclear plants, because nuclear energy has comparatively is so costly compared to these other sources of energy.
Michael, of the different sectors represented on your slide, and also as represented in the UN Sustainable Development Goals, which impact themes or sectors are currently the most active for private equity funds, and which themes or sectors have been lagging the others? And for those that are lagging, what might be the reasons why they are lagging?
Yeah, I'd say the top kind of impact themes we see interest in are climate solutions, obviously, and I think we're going to continue. That's going to continue to grow. I think it's a momentum. It's a wave that I think more and more of the science is going to point to this. That and a lot of the solutions are out there. It's kind of around execution. So I think that it's high, and it's going to continue to stay, I think, high. Food and beverage. I think we're changing the way that we think about our food and the impact it has on the environment. And so, I think it started with organic, but I think now it's moved like alternative proteins and beyond meat. And so those types of also those really high profile stories, like we worked with Vital Farms helping, introduce some of their early capital. And, they're, like a $1.5 billion market cap now, because they went public about 8 weeks ago. So I think those kind of stories, or those success stories where you've got the impact is kind of baked into the product or service, I think those are going to continue to, to stay at the high end. I'd say ed tech, where there's such a opportunity to disrupt the way that we currently do education. And I think with COVID now, that's going to even accelerate some of those things that were already in play. And emerging markets has always been a top one. I would say one that had less visibility, and that's kind of really now kind of shot much more up to the forefront, is diversity and inclusion. Just with the murder of George Floyd, and people are thinking, how do I? I'm going to do things on a lot of different levels, but how do I also do that with my money, with my assets? And so you're seeing that, and I think there was already this. There's already kind of like this. The conceptual logic was there. So, for instance, I think it was Darren Walker of the Ford Foundation talks about that talent is equally distributed by zip code, but opportunity, or you can fill in the blank, capital is not. So this idea that because of the systemic bias of the venture capital community all looking physically both kind of white male, that there's this whole kind of population of talent that gets overlooked. And so if people of color who are starting venture capital firms, and their networks are totally different, are plugged into that talent, that they can end up, having, really strong returns, because the current system is just overlooking. So that was the conceptual, framework was there, but I think the more recent events have really pushed that one, needingly, and deservingly to a higher profile. I would say one area that I think there's a lot of interest, but there's just, I don't know what, I mean, there's some reasons, but like, investing in water. That's one that I think everybody kind of like, there's like this kind of recognition that this is going to become, something that's more and more a valuable resource. And that there's kind of investment opportunities and importance around protecting that resource. But to date, that one's not been, it's hard to find investments in that. So I think that's part of that, is just like investing in that, category is difficult.
Lori, I would love to pick up that thread, if that's okay.
Please, yes.
That Michael started on the diversity inclusion piece, and makes two comments related to that. Women in VC just published some really terrific research about the number of women in venture, and it's only about 5%. So 5% of the all funds are run by women investors, and only about 4% of all venture partners are women. So it's an incredibly low percentage. But the good thing is they also have data about the number of women-led funds that have launched, and many of the funds have launched in the last few years. So many of them are fundraising and are getting started and off the ground. And we have two of the three partners at my fund are women. And so we were asked by one of our potential investors to measure the diversity of our deal pipeline. They were curious, like, what are you guys looking for that? Are you screening for that? And we don't actively screen for women run companies or diverse, ethnically diverse companies, but we did for this investor look through our deal pipeline and categorized it by gender and ethnicity. And it's typical that less than 10% of venture funded companies are run by women. We had 44% of our deal pipeline was diverse. And of the companies that we had done initial screens on and some level of first diligence, almost 60% were diverse. So it's exactly to Michael's point, which is if you have more diverse investors leading funds, you are going to find, because of our network, we're going to find those deals more naturally. And I've picked up a term that Michael and his team started, which was diversity drives alpha. We totally believe that. In fact, we ask our portfolio companies to make a commitment to building a diversity inclusion strategy and policy, and then to measuring how well they're meeting those goals each year. And just by the fact of having somebody ask them to do that, having an investor ask them to do that when you invest money and then measure it makes a big difference. It makes a big difference to be very intentional about it.
Mm-hmm. Thanks. Yeah, that was some very powerful data you just gave there.
One other, just kind of like a data point that's great, that's right on that is there was a McKinsey study done. I think it initially was done like 8 years ago, and they did a refresh a year ago, but where they basically looked at organizations and they were able to kind of identify organizations that had kind of a higher level of diversity. And they were able to kind of come up to a correlation where, the degree of your diversity, whether I think they were looking at it from a, ethnic and gender perspective, that drove additional profitability. So literally, like for every 10% increase in diversity, there was like a 0.1% of EBITDA increase. And so it really, and more it's getting tied to that it's just better way to operate your business. So I think that's, it's obviously, these are great proof points.
Thanks. Elizabeth, your LinkedIn link only went to all panelists. Can you share that again with everybody, all panelists and attendees? And Bianca, you put a question in the chat. If you haven't done it already, can you copy and paste that into the Q&A so it can be considered? Thank you, everyone, for putting in your questions. We already have 18 questions in there. As you know, if you've been on our webinars before, we won't have a chance to get to all of them. And that's where your upvoting is really important. I really do look closely at the questions that have received the most upvotes. So if you could put a little bit of your attention toward going through that list of fine questions and giving the thumbs up to the ones that you most want to hear our guests answer when we get to the Q&A in about 10 minutes, that would be very helpful. I want to talk a little bit about impact measurement and management of private equity funds. Michael, up until recently, IMM, impact measurement and management, has been a bit of a Wild West show for individual investors, for institutional investors, and for impact PE funds. Instead of settling on one or two methods that every fund uses, I found that funds often develop their own IMM strategies, and this may be good for the individual funds, but not necessarily good for impact investing, as it makes it difficult to compare funds within sectors and across sectors. And so I guess, do you agree with that? And how are impact funds embracing IMM in developing their portfolios of companies and in managing the impact of those portfolios? And how worried are you about impact washing among the large number of funds you see each year?
Yeah, I think this is probably one of the maybe fastest moving pieces of change, and it's obviously, I think it's a critical piece for to have more capital flow. into the sector. First, I think we recognize that different investment strategies have different impacts. That's kind of the nature of it. You can't kind of like totally turn it into a gap model where everything is kind of universally has a metric. So to that extent, to which a manager has been thoughtful and specific in the ways that they capture impact, I think that should be encouraged. I think the other piece is precision and transparency at both the deal and the fund level, I would say is more important than this aggregation, kind of desire. So that being the case, the industry really has made tremendous progress on first getting aligned on the process, and so that's like the common key steps that all impact managers should be taking, and also the data, the underlying common metrics that should be captured in whatever sector you happen to be investing. So I think there's really 4 pieces that have come, to be considered best practice. You've got the SDGs, you've got the impact management project that you mentioned. There's also something called IRIS, which kind of gets more to the kind of definition. And now there's this, it's called operating principles for impact management. And so those 4 pieces are becoming the standards, which would be comprised of kind of, if you were saying I'm following best practices, those are the 4 pieces. So we have those standards, and it's frankly becoming much easier to get to root out impact washing because of that. So on top of these standards, which really have only emerged in the last few years, we have a growing discipline of assurance and verification. So we're seeing allocators, i.e. investors, in integrating independent verification into their due diligence and into their way they're rating the managers. So I think the keys to this question of impact washing, I think the keys to avoiding impact washing go back to this clarity and transparency. And so investors are not saying they want everything to look a certain way and to have a certain type of impact. They just need to know what they're buying. So the progress on these standards and verification at the industry level, we see as hugely positive. And just there's a group called Tideline that is one of the leading advisors in this. And now I think just recently they've rolled out a subsidiary called Bluemark that's going to be more on the verification side. And I think you're going to see more and more of groups coming to the marketplace that are really helping on that verification side. But like I mentioned, those 4 pillars have now been established, and I think you'll continue to see kind of innovation around that.
Thanks. If anybody is interested in doing deeper dives in this whole impact measurement and management space, we've done about 5 or 6 webinars on different aspects of this. Sarah Olson's recent fireside chat, Jane Reisman helped me organize a couple of ones on IMM. Just go to our archive for that. Also, you mentioned the Tideline new initiative on impact fund analysis and certification. We're going to be doing, Christina from Tideline is going to be with us in February 25th to do a webinar on that initiative, which is really, really interesting. Amy, can you, we got a few minutes and there are a few more questions I want to add, but can you just share a little bit about how you measure and manage impact in your funds?
Sure. So we are conforming to the UN Sustainable Development Goals, and we have selected 9 of those goals that our fund will be seeking impact within. And then we ask first of all, we screen businesses for their fit to those 9 goals. And then when we make an investment, we have written into the side letter a commitment to report and measure impact that is specific to their business. So in the case of our first investment, a company called Raptor Maps, they are making, they have software that can analyze drone footage that is captured of utility scale solar farms, and they can determine which of the solar panels need repair, and they can measure the output of solar energy from those solar panels. And what we've asked them to do is to report out to us on a quarterly basis how much solar power has been analyzed on their platform, and then we can compute a carbon avoided calculation there, carbon emissions avoided. And then they're also measuring diversity, as we had mentioned, in our according to our goals. And so we'll aggregate that across our portfolio. But we will also very likely, as we build out the portfolio, use one of the consultants that Michael mentioned, just to make sure that our methodology is sound and current, and to get that independent stamp of approval. So we have sort of an idea that we've crafted so far, but we'll definitely work with one of the expert firms to make sure that our measurement and reporting is using best practices and is independently credible.
Thanks. Moving right along here, I want to discuss briefly what it's like to create, raise, and run a fund. First of all, I think it might be interesting to our audience to hear your thoughts on who is best suited to run a fund. In our last webinar, Bridges Fund Management's Brian Trelstead argued against a commonly held belief that the best impact fund managers bring financial and investment expertise to the table and then learn impact along the way. He actually feels that it is better to have, if there's an archetype here, it's better to have a strong grounding in and understanding of social and environmental issues and needs, and then develop the financial and investment expertise necessary to have and run a successful funds. He believes that authentic expertise around impact is actually harder and takes longer to develop than financial and investment expertise. And I'm wondering if one or both of you could briefly kind of comment on this. Do you agree with Brian there?
I'm happy to comment. I think I do agree, because I think the thematic expertise, the domain expertise, is super important. Well, certainly not in there's plenty of generalists in the venture investing space, but in the climate space, really understanding energy markets, understanding regulations and rulemakings, understanding utility business models, and the way that the broader kind of energy industry functions is really, really critical. And I think what we saw in the first wave of clean tech venture that didn't go so well is you had a lot of generalists come in and try to apply their generalist tech methodologies to this complex industry, and I think had real they had blind spots around a lot of the policy and rulemaking and regulatory elements of the industry. So I would tend to agree with him that I think that thematic driven funds, focused funds, that we had known also that new fund managers that have a very specific thesis have been the ones that have been outperforming also over the years, right? So as the funds get bigger, they usually start out and they get great returns because they're very focused, they're very thematically focused, they know their space, they're experts. And then as they grow and they get bigger and raise subsequent funds, they are very much drawn into raising larger funds, and they're starting to lose touch with some of that unique specific perspective that they have. And so we see that the returns are typically being reduced as the funds grow in size and raise subsequent funds. So that's been a lot of what the Cambridge data has shown as well. So I would tend to agree that expertise, whether you're an operator, coming into venture from being an operator in an industry and now being an investor, that also gives you great advantage, and I think would fit in line with what he's saying as well.
Great. I want to get to this 1 o'clock. I want to get to the audience Q&A, but one quick question for you, Michael, for the benefit of the entrepreneurs in the audience. What are the best strategies and where are the best platforms that an impact entrepreneur can use to find early stage fund capital for his or her business right now? There's a lot of evolution that's happened here, a lot of platforms that have failed over time. What do you recommend where people look? Or
if you're talking like angel, I mean, just to kind of put it in context, if you're talking about angel capital, say we're looking to raise less than $1 million and it's kind of your series, you're kind of a seed series, your best is still, it's not, I don't think the impact space is necessarily unique in the sense of where that capital is going to come from. It's usually going to come from someone who's close to you or someone who really knows the industry of the business that you're starting. They can really kind of see the future, see what you might have that's unique, and how your business, experience kind of matches up to the opportunity. I think that's kind of your best bet. I mean, there are networks like, you know, it used to be called Investor Circle. Now it's Social Venture Circle. That's kind of a network of angel investments. You know, Tonic is a group of family offices, Gratitude Railroad. I mean, these are groups that where there is some, you know, aggregation of investors that are interested in doing direct investments. You know, you can try approaching, you know, family offices, but many times it's going to be tough because they either don't do directs or they'll do later stage stuff, or it's very, you know, kind of insular. So you really almost need kind of an introduction or kind of that, what we call transference of trust introduction. But yeah, I think it's not in that context. I don't think it's different from raising angel capital with a non-impact company.
Found it interesting that one of the platforms that I used to kind of search through private equity funds in the space was Impact Base, which I think was produced by the Gin. They closed it down in part because the space was growing so fast and it was just hard to keep up with all the new funds and in an effective way. Is there something like an Impact Base that exists out there where someone can go in for funds specifically?
I'm not familiar with anything. I mean, I was familiar with Impact Base as well, but I'm not familiar with any kind of source, kind of open source that's out there right now.
Mm-hmm. Okay, great. Let's get to the audience Q&A. Sridhar, if I'm pronouncing it right, sorry if I'm not, you win the upvoting crown today. Congratulations. What are the metrics beyond thesis that you look at while shortlisting a potential investment, I'm assuming, in the pipeline? Amy, do you want to tackle that one?
Sure. So we are looking for a really scalable business, you know, a business where a little bit of capital will go a long way and where there's a large total available market. So even though the company may be starting out applying their technology in a specific application space or to a narrow set of customers, you know, how likely is it that they can grow to other customers into other markets? So that's really, really critical because, you know, although most companies that are in venture portfolios don't go public, most of the exits are through corporate M&A. You are still trying to have a few companies in your portfolio that have that opportunity for a very large outcome. And so you're looking for a very, very large market. It's really helpful if the management has experience, especially in a related industry, you know, if they've been through, even if it wasn't a successful outcome, but that they had leadership experience in a particular category, that makes a big difference as well. So seeing that they maybe been through this isn't their first rodeo and they've been through this dance before, they understand, you know, they've got some management experience, they know how to work with investors. Also seeing how coachable they are, you know, when folks decide to take venture capital, how willing are they to work with the investors who they should be selecting for their experience? And so, you know, knowing how to run a really good board meeting and to work with the board to really get the best of them and to seek out help when you need help, and then also really being able to listen and hear, you know, some tough love and being able to not, you know, be defensive about that. But also really to be seeking a lot of additional insights from advisors, board members, and trying to, you know, turn that into the most successful company. That's a really big factor as well. And then we like to see some customer traction. So at the Series A level, we're looking for folks that have some revenues and some proof from customers that their solution is commercially attractive.
Thanks. Michael, next question from Annabella is for you. What happened to that? Oh, did you already answer that one?
No. It should be what I'm seeing. What are investors' biggest concerns when starting impact investing?
There was one question directed to you. Yeah, okay. Yeah. Well, let's go right to that one.
Yeah, that was a major softball question. So I answered that one.
Oh, okay. And so Annabelle is asking, what are investors' biggest concerns when starting impact investing? How do you convince them to invest in your funds?
Yeah, so I would say and it depends on the the kind of entity, if it's like a family office, I mean, a number of times we'll see kind of where, say, the Gen 2, generation 2, younger family members are pushing the Gen 1 to invest. And then there's always this kind of question, well, I remember when we had one story, it's a pretty large family where the Gen 2, went to, her parents' advisor and said, hey, I want to do this. And the question the advisor says, well, how much money do you want to lose? So that's kind of the mentality of it. So I think it's that, here again, it goes back to that myth busting that you can have nice returns in this sector. So I think that's probably the biggest, I think part of that is now there's enough data out there and, from very reputable sources that can counter that. So I think there's an education process that's part of that. So I'd say that's, and what was the second part to the question?
Let me pull it back up here. How do you convince them to invest in your funds?
Okay. For us, I mean, with the clients that we're working with, it's, part of this also is like finding fund managers that have a track record, that they're, it's a very marketable fund. But here again, I think it goes back to the education of like, just like you would any other investment, showing, their track record, where they've, what kind of in companies and sectors they've invested in the past. And, showing that this is both a great investment and has, really meaningful impact.
Okay, Michael's has a couple questions that have received a lot of upvotes. First one is, could we get an idea how the large impact funds keep the impact culture? Do they establish clearly defined impact targets? Which tools do they use mostly to measure their impact against their targets? Do they report clearly on corrective actions when needed? And then he also asked an interesting question that I'll just attach to this. How are PE partners compensated related to impact? Is it a significant part of their compensation?
Amy, do you want to first or me?
Let's see. The impact culture. Usually in our case, it's really baked into their business. So it's not necessarily a matter of culture. It will scale with the successful growth of their business. So, and that's one of the kind of nice things about, climate tech investing is the more successful the companies are that we've selected, the greater their impact is naturally going to be. So it's not something that has to be done in addition to running their business. I think the measurement we design the measurement based upon what their business is again. So I'll use the example of this company, the solar software company, where they're measuring how much solar energy they have analyzed through their platform. And so we will compute a measurement of carbon avoided based upon solar power. And, this company is also very helpful for investors. So we can start to measure the additional capital that has come in to new solar deployments that are in their customer base. So it's usually designed very specifically to the business, to fit their business, so that it isn't some big additional exercise they have to go through, each quarter or each year, that it's really inherent in how they're running their business. And so it's something that they're kind of naturally accumulating the data on. It isn't sort of a big exercise, or they don't need to have somebody that goes through a lot of data analysis in order to deliver us that number. It's quite, it's quite inherent in what they're doing.
Michael, do you know of any private equity funds whose partners are compensated, part of their compensation is directly related to impact, to measurable impact?
I can't name one, but I've heard, I think there is that out there. We don't kind of see that aspect when we're working with our clients, but I know that's, I think that is out there. And I think that the question about the impact culture, we had, this is a little bit of a war story, but we had a company that we were helping go through a sale, and it got down to the very end, and the founder, our client, wanted certain terms built into the, kind of, I'd call them teeth, into the purchase agreement that would say, I want to, you have to kind of preserve the quality of the product and the efficacy of the product. And it was, the fund that was looking at this, it was too much for them, to sign up for that. And so the deal didn't happen, so that it is a real question. And I think it's a real, it's a real world issue of how you actually do that. And there's sometimes, in this case, the founder said, I'm not going to sell.
Luke, if you want your comment to go to everyone, you need to copy and repaste it and choose panelists and attendees. All right, a couple more questions here I think we have time for. Jen asks, I'd like to hear your thoughts on fundraising in the current environment and views on how to position a fund with a specific sector focus, given the shifting interests of investors that Michael has not just noted. Amy, you want to tackle that one first?
Well, I have to be really careful when I talk about fundraising since we're in the course of it, but I will say that one of the biggest challenges right now is the lack of ability to meet in person. It has really been hard. When I raised my prior fund, we did a lot of in-person meetings and I traveled really frequently. And that's such a better way to get to know somebody, especially if it's a manager that you're selecting for the first time. There's nothing that really replaces sharing a meal with them or, having them come into your office or having, them do like a site visit. I think that's the biggest constraint right now. And I think these kinds of tools, Zoom is sort of an important tool and is what we're all relying upon until we can get back to meeting in person. But personally, I just really miss it. I really miss also I also found so productive all the conferences, like Big Path hosts a lot of events. And so there's nothing that replaces like standing and having a cocktail and talking to somebody about a current event or some activity of their kids, and then finding that personal connection that you don't get in these kinds of environments. And so missing that serendipity and that personal connection that comes out of, gathering in person, I think is honestly the hardest thing right now, that's been really constraining.
Mm-hmm. Beth has a really good question. What are you seeing in terms of minimums for private equity funds? Any effort to lower them so that more investors can put their toe in the water? Many investors who have the capacity to do more want to take small steps initially.
Yeah, I mean, I think a lot of times the minimums will kind of be driven by the size of the fund. So if it's a $50 million fund, you might have a $250,000 minimum, but if it gets 100 million, that could go up to a million minimum investment. I think there are instruments that are getting formed that make it what I'd call more of a retail, where you could make, retail investment, smaller investments in kind of a bucket of funds. I can't think of any names right now. Probably wouldn't be good to name them anyway, but I think there is that out there on the impact side that where you can do smaller investments that makes it more, kind of democratizes private equity. Amy, do you?
Yeah, I could definitely talk a little bit. There's sort of two things. One is there's AngelList is enabling these 506c funds, which are doing rolling closes, and they're mostly utilized to bring in small investors into a smaller size fund, like Michael's talking about. So one that is sort of high profile in our space is Jason Jacobs is doing this. He's the guy that does the My Climate Journey, and he's raising a small fund, and he's been doing rolling closes, and meaning he invests as he gets the money and the commitments from the investors. But it's usually for very small funds. And then the other angle is SPACs. So a special purpose acquisition corp is a publicly traded investment vehicle that is acquiring a significant share of a private company and taking it public. And then it's open to retail investors. So anyone that has, a trading account, whether it's on Robinhood or Schwab or whatever, can invest in that SPAC. And what's exciting in our space right now is that it's providing liquidity to a lot of these companies that have been kind of stuck. They're not ready for a traditional IPO. They've raised, in some cases, hundreds of millions of dollars. They've got a decent amount of revenue, but they're just like, it's hard for them to get out and find liquidity for their investors and for the founders. And so those have been the target of a lot of these SPACs, especially in the electric vehicle space, the renewable energy space, in some of the food and ag areas as well. So that's opening up investing to a wider group of small investors, and it's providing liquidity to the early investors and the founders. And I think it's generally a good thing for our space because those folks will hopefully reinvest with that capital that they're taking out of the business.
Thank you. Well, everyone, unfortunately, we're at time. For those of you who missed any part of this webinar, for all of you who'd like to watch it again, I'll be sending you a link and password via Eventbrite in the next few hours, and that'll be good for a week. So be on the lookout for that. I'll also include the full chat box, at least all the messages that went to everyone, and the whole Q&A. Make sure you have Eventbrite in your contacts so that the email doesn't get lost in spam. Now we have continue to have a very full schedule of autumn programs with fireside chats all the way into the month of December. Next week, and I just shared the links for these, we welcome Harvard Business School's Vikram Gandhi and Sean Cole, and the title of that program is Teaching Impact Investing at Harvard. That's going to be very interesting. And then right after that, some of you may not know this, but there's a rather important election happening next week. And so the week after that happens, we're going to have a special post-election program with Mission Investor Exchange's CEO, Matt Onick. And it's called Post-Election Philanthropy, Safeguarding the Heart of Impact Investing. And as I said, I shared the link for that. The other two November programs are in our calendar right now, so you can just go there and check that out. There's the link. And remember to consider premium membership because you get automatically registered for all our live programs like this. You don't have to register individually, and you get the whole archive. So you can just kind of go through the 50 some odd programs and dig deep on lots of different impact related topics. Boy, Michael and Amy, thanks so much for your time and for providing us with such really informed and valuable insight into impact private equity funds. I really appreciate it.
Thank you so much, Lori, for having me today. And you have such an engaged audience. It's clear that you all are taking this very seriously. So I'm really grateful to be able to talk with all of you. And maybe one last thought that I would have is, this is a really important election, especially for the climate and especially for democracy. So I know that not everyone here is in the United States, but I hope that everyone is doing what they can to make sure that their vote is counted and also helping others to get their vote out. So I know I am waiting with great hope and optimism that we will have a good outcome in the election and better leadership on climate change moving forward.
Laura, just thank you, and it's just kudos to what you built. It's fun to kind of get a little bit of a better feel for the network you've created. So kudos on that. And Amy, I really appreciate you being here and getting us to do this together. So thank you.
Yeah. Thank you both again. And thank you all the audience attendees for your great activity on the chat, for all your questions and your upvoting, and just being present for these important discussions. Thank you for coming. Hope to see some of you next week for our next program. Take care, stay safe, vote. So long.